Hey, good morning options traders, and welcome back everyone. And in the past few videos, I have used the terms a lot more recently about gamma, and in particular, negative gamma. Now I do have another video in this forum talking about gamma in general, both positive and negative, but it seems that negative gamma gives people the most trouble. So let's just talk specifically about that. What is negative gamma? What does that mean for our option strategies, and how do you interpret it? Well, to do that, let's start off first by looking at long shares and short shares of stock and their deltas. And this is important to understand because gamma is just showing us the rate of change of these measures. So right here in green are long shares of stock. This is what your risk graph looks like if you buy 100 shares of stock for 100. There's our break-even point right there at 0. So if the stock is trading for 100, we haven't gained and we haven't lost. But notice that if the stock moves up $5, we make 5. If it moves up $10, we make 10. Moves up 20, we make 20. It's always dollar for dollar. That's delta 1. And the reverse is true. If we fall 5, we're going to lose 5. We lose 20 out here, falls to 80. We're going to be down 20. Always dollar for dollar. Now short stock is here in red. It's just the opposite. So what this means is that if the stock rises 5 points, the short stock position loses 5, right over there. And if the stock falls 5, the short position actually gains 5. So it's just the opposite. It's the trader on the other side of the trade. Whatever the long position gains, the short position loses, and vice versa. But the thing that I want you to notice here is that these lines are perfectly straight. And that means that our deltas never, ever change. And so again, gamma measures the rate of the change of these deltas. So the stock has positive deltas. It leans up this way to the right. That will be important for a little bit later in this video. And the short shares lean this way to the left. They have negative deltas. That will also be important because again, this is what gamma is always measuring, is the rate of changes in these deltas. So with that little background, remember that gamma equals curvature. That's probably the simplest definition. Whenever you're saying that a position has gamma, it means that its risk graph has some sort of curvature to it, unlike the graphs that we just saw. All right, so gamma measures the curvature of your current risk graph. Now, technically, we can get some insights into gamma from the expiration graphs, but it's really apparent when we're looking at the current risk graph, or what's called today's risk graph. So remember, if there's no curvature, you have no gamma. So let's go back to our long stock position. We have delta 1, right? No matter where we measure, we're always delta 1. But do you see that this line is perfectly straight? There's no curvature? Well, that tells us that no matter where we measure it, the delta is always 1.0, and therefore there's no changes in that, so there's no gamma. What about the short stock position? It's a straight line. There's no curvature to it. And that tells us that no matter where we measure, we're always going to find that the delta equals negative 1.0. And therefore, because that answer never changes, there's no gamma. So what does negative gamma mean? What it means is that your current risk graph slopes downwards. If we're looking from the bottom of the graph, it's going to be concave. So you can think of it a little bit more like a frown. And more specifically, what it's telling you is that there is an inverse relationship between the current stock price and the delta. So what does that mean? It means that if the stock is up, your deltas are going down, and if the stock is down, deltas are going up. That's what negative gamma is. So it's this inverse relationship. Stock up, delta down, stock down, delta up. That's what you want to understand. So for instance, let's take a look at an expiration graph for a covered call. We're long shares of stock and we've written a call. So notice that at expiration, if the stock is above our strike right here, this bend at 100, the line is flat, it's horizontal. And that means that we have 0 deltas. It's just like we have 0 shares of stock in our account, but because it's perfectly flat, we also have 0 gamma. But take a look over here. If this option is out of the money, we're long shares of stock, so we have 100 deltas. Our call is worthless, so we just have shares of stock with 100 deltas, and because this line right here, this line segment, is straight, there's no gamma. But can you see what's happening if the stock price moves from the left side of the graph, starts heading up? We go from 100 deltas and eventually hit 0 deltas. We are subtracting deltas from our position. We're reducing the size of our deltas if the stock price rises. If we come in this direction, we're going from 0 to 100. So again, this is the expiration graph. You can see that it does have negative gamma if you know what to look for, but it's a little more apparent when we look at the current curve. So recall that the current curve here in red is our profit and loss today. The blue curve is at expiration. But today it's showing us what our profits and losses will be at these various stock prices. So if we start from over here at the far left, let's say the stock is down at 80, do you see how this red line is sloping upwards a pretty good bit? Not quite as steep as it is here in blue. It's not quite 100 deltas, but it has positive deltas. It's pretty close to 100 shares of stock. But if the stock price rises, let's say up here towards 90, do you see how this segment of the red graph is not quite as steep? In other words, if we extended a line from this first arrow and one from the second arrow, you can see that that second arrow is pointing a little bit lower. You can think of it as maybe pointing more to the east, if this is east out this way. And that's because this segment of the red line is not quite as steep. We've gotten rid of some of our deltas, or at least the option strategy did that for us automatically. What happens if the stock comes up here maybe to 110? Do you see how this red line is getting a little bit flatter? And finally, if the stock comes way out here, let's say past 120, eventually we would see that this red line would be perfectly flat. So what's causing this? Well, if the stock is way up here, let's say at 120, we have 100 shares of stock in our account, which are always 100 deltas, but we're also short this call. And this call is very deep in the money, getting close to expiration, which means those deltas to us are minus 100 deltas. They're plus 100 deltas to the long call owner. They're minus 100 to us. So if I have 100 deltas from my stock position, minus 100 deltas in my short call, I've got 0 deltas, and that's why our graph is getting flat out here. But if the stock price falls in this direction, what's happening? I still have 100 deltas from my shares. They're always 100 deltas. But what's happening to my call? It's becoming more and more out of the money, which means those deltas are getting closer to 0. So if I'm long 100 deltas and basically short 0 deltas, on a net basis, I'm pretty close to 100 deltas. And that's why this line is sloping more upwards here. So what's happening? If we move from the left side of the graph, I've got 100 deltas, or at least pretty close, and I start working towards 0. I am subtracting deltas. That's negative gamma. And if I start from the right side of the graph, close to 0 deltas, but the stock price falls, I start increasing towards 100 deltas. Stock price down, delta up, stock price up, delta down, that's negative gamma. And you can see that this red line looks a little bit like a frown. It's curving downwards if we look at it from the bottom side of the graph here. That's another way to tell that it's negative gamma, and that it will be subtracting deltas if the stock is up and adding deltas if the stock is down. All right, so here's one for you to try. Here is a condor, another type of strategy. Blue line is at expiration. The red line is our risk graph today. So what do you notice about the red line near the center right here? Well, it's pretty flat in that small segment right there. So we have pretty close to 0 deltas in the center. But what happens if the stock price rises out this way? What's happening to our line out this way? Do you see how it's starting to lean left? That's negative delta. So what is that telling you? We go from 0 deltas. If the stock price rises out this way, we're getting more negative. We are subtracting deltas if the stock price rises. What happens if the stock price falls out this way? Do you see how this line segment here is pointing more upwards, like positive deltas, like long shares of stock? So what's happening? We're going from 0 deltas. We are adding deltas if the stock price falls. And another way, we could look at this red curve and see that it looks more like a frown if we're looking at it from underneath the graph here, from the bottom. That's negative gamma. This strategy is going to short shares of stock for us if the stock price rises, and it's going to buy shares of stock for us if it falls. So those are the basics, really, of negative gamma. So I hope that helps you to understand what it means. However, how you use that and why you would use that is a different story. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.